welcome everyone to our first Feldmeyer Forecast for the first quarter of 2024. We thank you for joining us here, and it is hosted by Ben Feldmeyer and myself, Derek Miller. As we go through this presentation, we hope you guys find it informative, but if you have any questions, feel free to drop us an email at team@feldmeyerfinancialgroup.com, and we'll respond to you as quickly as we can. So as we dive in here, we want to talk about the topics that we will cover today. The first one is, as we ended 2023, how did the equity market do? We saw great returns in the S&P 500, but we want to look at the index versus just the top 10 stocks. Something that's been on everybody's mind for a while has been inflation, interest rates, and then always fun to wrap up with this year is a presidential election year. So what does that mean? As we wrap up, we'll talk about the $6 trillion of cash that we have in money market accounts and how to address that uncertainty when it comes to investing.
So Derek, as you touched on, taking a glance at the equity markets last year, the S&P 500 was up 23%, I believe. And when we break this down, remember the S&P 500 is the biggest 500 stocks or companies in the United States. We see there where the arrows pointing, it says 86% of the rate of return came from the top 10 stocks in that. And those are all tech companies. So tech got on a roll at the end of the year and had some big movement, and that pulled up the other 492 companies, which, as we can say, just below that 86 were 14% of the performance on things. So tech has been on a nice roll. There's lots of room for everything else to have a chance to move, but we want to be careful of thinking that every company out there was up 23% last year because the math wasn't there.
Mm-hmm. Yeah. So then if we look at inflation, we've heard on the news that inflation has been dropping, which is great. But if you think about it, inflation is the rate at which prices are increasing. So while we're going to the grocery store and we feel like prices are still going up, that is actually true. Inflation can be falling, but prices can still be going up. The question is just at which rate are they going up? If we look at the 50-year average, we see that right around 3.9, call it 4%, has been the 50-year average going all the way back to 1973. If you look at October and November of 2023, the most recent data that has been released, we can see that inflation has been falling closer to the Fed's target of 2.5%. Right now, as of November, we're closer to 3.1%. So while prices will never go back to what they were in 2021, because we did see that big increase, our goal is that they just start to or continue to increase at the historic norm. If prices fall back to 2020 or 2021 prices, that is actually a bigger concern because that would be considered deflation, which is usually a very bad sign for the economy, something like a depression, not even a recession. So it's something that we're keeping an eye on. Inflation matters because what the Fed is targeting is 2.5%. And while job growth and job openings, the labor market stays strong, the Fed's going to continue to look at inflation. Until inflation meets their target or other things start to crumble in the economy, we don't think the Fed's going to cut rates. However, that being said, we do believe they've had their last hike.
So this slide is taking a look at when we reach the end of a Fed hiking cycle. We see different time frames on things here. So on the left-hand side, we see the stock market. Each of those different colored lines would indicate a different period in time and what the performance of the stock market was over the next 2 years. So if we called right now, right, the end of the rate cycle, we would look for 2024. I'm going to mess up and say 2023, 2024 and 2025, right? What's our expectation? So we see the red line there on the left at the bottom. That is our track that we're on right now. And we see things, the market is trending upward on things. Now, a couple of things to point out, that purple line right next to it, that's 1999 and 2000, that 2-year period. The Federal Reserve was certainly done raising rates, and we fell into the tech bubble and the tech wreck and a 3-year long recession. So that one was really kind of a one off. On the right hand side, we see the same type of a chart, but this is looking at the rate of return of the 10-year treasury. And again, we see everything trending in an upward direction. So right now, I always use the words cautiously optimistic, but we are optimistic about both the stock market and the bond market as we head into 2024.
And the reason that we're optimistic about the bond market going forward is we have to kind of take a step back and figure out, how do bonds work? A bond is a loan, and every bond is issued at $100 and matures at $100. So let's say the bond that we're purchasing is giving us a $5 dividend, and that equates to a 5% yield. Now, what happened after the financial crisis all the way up until 2022 is that interest rates were near all-time lows. So let's call it 3%. Now, that same $5 was being paid out, which means to get rates as low as 3%, we had to pay a premium for our bond, or $110 in this example. So once 2022 happened, the Fed started raising rates and the overall market started to increase rates as well. That means that our bonds dropped like a brick in value. So if we look at that, our bonds are now paying at a discount.
And we knew this was coming.
Right.
Right. We knew bonds were going to accelerate in price as interest rates fell, and as interest rates rise, they're going to fall in price. So we made recommendations to address that.
Correct. So we had little to no bond exposure, to the best of our ability, but we still wanted to have well diversified portfolios. We just had to be careful about where we were investing in certain bonds. So the bonds that we were buying were shorter duration. So if rates went up, our bonds didn't fall as much in value. So
that's what we see with the little arrows there.
Yeah, the right. Little arrow here. So if we look at what duration is, duration basically means for every 1% change in interest rates, the bond portfolio will move in the value by its duration. So now that we know that, or we believe rates have kind of reached their peak, and any subsequent movement would be the Fed cutting rates, we actually want to extend our duration. So that way, as these prices start to fall, we should see or the interest rates start to fall, we should see our bond prices start to increase in value. So for example, the recent rebalance that we just did in the Feldmeyer Financial Group bond model, our yield is still 6%, which is great. Our premium to discount, we're actually paying $88.56 per bond. So it is a discount of almost $11.50.
Because we know it's going to mature at a value of $100.
Correct. Every bond.
You buy it at 88, we know it's going to be worth 100 at some point in time. It's going to go up in value over time.
Yep. And the one thing we talked about earlier is the duration that we really want to pay attention to. So let's say we don't know if the Fed's going to cut rates by a full percentage point next year. Let's just assume that they do for discussion purposes. If the Fed drops rates by 1% in 2024, it is likely our bond model should experience a price increase of 5.17%. So not only do we get to collect our over 6% in yield, but now we also get some capital appreciation in the price of our bond as well.
And in that example, that would be 6% yield plus capital appreciation of 5% would lead to as much as an 11% change in value.
We could have a potentially double-digit rate of return in our bond portfolio with a lot less risk than the equity portfolio. So
yeah, that's a stock market rate of return. Yeah, 11% is the long-term average of the S&P.
Yeah. So with that, we go, where do we invest, or should we be invested, right? Because it's an election year, and whether you are a Democrat or Republican or somewhere in between, yeah, we hear it every year. So
yeah, Derek and I were reviewing all this stuff before we got started with the presentation, and I said I'm more than happy to address this slide because every 4 years, in the 30 years that I've been in business, it seems like I have the same conversation. I sit with my clients in my office and I say, I don't know that it's ever been this crazy out there. It just seems like it's getting crazier and crazier. And of course, we we talk with folks that are both on the left and on the right, and of course, a lot of folks that are in the middle. But there's a question sometimes of should we just go to cash until we figure this out? So we got this slide that actually shows the performance of the S&P 500 during the different administrations, and the red being indicated the Republicans and the blue being indicating the Democrats. And of course, we see that really, you know, for the last 40 years or so, it hasn't so much had to do with who's in the office as much as it is what's going on in the economy. For example, if we look there at G.W. Bush, we see that's the 2000 through 2008 timeframe where we were in one of the longest, deepest recessions we've had, coming out of the tech bubble.
Tech bubble and financial
And
crisis.
financial crisis, yeah. So I don't know that that has so much to do with who's in the office as it does just what's going on in the economy. Also, out on the end, notice that the Biden administration shows a 1% rate of return. That's the 2022 rate of return. This slide was actually created before the end of the year, so 2023 is not included. 2023, the rate of return was 23%, give or take.
Mhm.
So if we add that to the 1% the year before, that's 24. You divide it over the 2 years, that would be an average rate of return of 12%, right? So it's kind of keeping up with just about everybody else.
So an interesting approach is to only invest when your party is in office. But this slide shows us that it's not a great investment strategy. Don't get political when it comes to your investing. So letting your political beliefs get in the way of a buy and hold has been extremely costly if anybody's actually done this. So if we go back 70 years, if we had $1,000 invested in the stock market when only a Republican is president, it would be worth 27,400 today. If we had 1,000 invested only when a Democrat is president, it would be worth about 52,000 today. But if we just took that $1,000, invested it in the S&P 500, closed our eyes, never sold it, regardless of political party, it would be worth $1.4 million today, because we're not trying to time the market or thinking things are going to be bad or good if our party's in or out of the office. So these are the two parties compared to each other. And then if you put that on a different axis, it is pretty crazy that in 70 years, your $1,000 could turn into 1.4 million if you just stayed invested.
Well, it's just a different method of why you're trying to time the market.
Yep.
So one of the things we also want to touch base with is the amount of money that's in cash at this stage of the game. So this chart goes back to 1993. We see a nice, excuse me, climbing in the amount of cash that's on deposit. We see our first peak there around 2002. That would be because money was put into cash because we were in the big tech wreck, right? 2000, 2001, 2002. Cash starts to go back down as the economy improves, and then it runs back into a cash position, all-time new high in the 2008, 2009 credit crisis. Then as the economy improves and we head back out, cash comes back down for an extended period of time. But then we get to what? What happened in 2020? Well, COVID happened. So money starts flowing into cash because there's this fear of where to put it. And now it's spiking again. Not only we believe there's fear out there, but also because the short-term interest rates are so high that it's money markets are viewed as a place to actually invest. Money markets are not an investment. They are completely and totally short term, shortest term investments for their short-term bonds is what they are. Commercial paper, money market shares are completely liquid. So while we're extending the duration to help lock in rates at this stage of the game, the common investor is still pouring money, sometimes within their 401k plan, into the money market accounts because they view it as an investment. These rates are not going to hold, and that money is going to come back out at some point in time.
And when we talk to different economists and portfolio managers out there, their big concern is the short-term yield curve is high, right? So you can get over 5%. Starting this year, you could have gotten 5+% in the money market account, which is a great return. It's already below 5 as of this recording, which is January
15.
15th. And the concern is by the time that interest rates drop and our money market accounts yields drop back to below 3%, if we wait to get out of the money market account up until that point, all the opportunity for getting into those bonds at those deep discounts are already going to be lost.
And we may have lost those.
Yeah. So one of the things to say, this was a great short-term strategy because they were paying over 5%. We've recommended it over the past, but if we start to say it could be worth considering getting out of it and getting into something else now, that's the difference.
And it's not a long-term investment strategy. If you're saving money for a short-term goal, it's a perfect place to put some money. Or excess cash reserves, perfect place to put some money. Why not earn some extra money on it? Okay. But this is not a long-term investment alternative.
Correct.
So on that subject itself, I'm just going to read this because we put a lot of time into actually coming up with these words. Fear in the marketplace, fear of the economy, fear of the unrest on a geopolitical basis, fear of who's going to win the election. Fear often causes investors to adopt a short-term focus. They become obsessed with the immediate impact of market events in the news, losing sight on their longer-term financial goals. And this short-term thinking can lead to impulsive decisions that are not aligned with a well-thought-out investment strategy. So our recommendations are, if you have a concern, we have a concern. We want to talk to you about it. Talk to your advisor. Also, let's look at the big picture. Let's look at the stuff that we've presented today. Let's also set investing goals. What is the objective for our money? Let's have a strategy to accomplish that. And let's be sure that our financial plan is updated so that we have confidence in the decisions that we're making and we know what it is that we're doing. The other thing is, don't become discouraged. Financial planning is there to put confidence into all of our decisions. And even with all the planning in the world, sometimes the market goes down, but that's simply an opportunity because we know it's not going to go down and stay down forever. It's just a buying opportunity. So as we wrap things up, I'd like to thank everybody for joining us for our first quarter outlook on things, the Feldmeyer Forecast, as we're calling it. And we look forward to seeing you or talking to you sometime in the near future.